What is up, traders? This is Nick Bentley. Happy March 22nd. It is Fed Day, one of the most important decisions that he's made. And I want to show you a trade that we actually took on gold that we were able to benefit from because of the Fed's decision. But we were able to limit risk significantly, even though volatility was very, very high. So I'm going to show you how to trade on Fed Day. All right, guys, so as you can see, we made $5,590 on gold on Fed Day. Today is, again, March 22nd. The Fed came out. They announced that they were going to raise rates a quarter point, and we were able to capture about $5,500. But I'm going to show you how we did that, okay? I'm going to go over here onto our Facebook group where I actually walk through specific trades that I'm taking with some of our members. So what I show them is I show them levels that we're willing to take, and I also go through how I'm managing and thinking about the trade. So I say here, guys, here's the trade identified that in the group that we had in class the other day, and I put a limit order in on a 4-hour level. So I'll show you that level. We have an area right here at previous highs where big green candles come out of that. As we came back into the level, we had momentum on our side. So in all my videos, guys, you hear me talk about the line of least resistance and momentum. The line of least resistance is upwards, and our momentum is well within the rules that we have here that allow us to take a position. But what I stated was that, whoops, there we go. What I stated was that you can see it's not acting right. It's kind of basing in here. And this is typical when you're in a position on Fed Day. There's a lot of unknowns and a lot of things that the markets are waiting for. So what I said was, because of that basing, if we do pop up and make a slightly new high here at 1949.50, I'm going to move our stop to break even early due to the expectation of increased volatility on the day. And I wrote that this morning at 9:21 a.m. So and then I go on to tell them why I'm doing what I'm doing. We did pop up, price went to 1951, and we were filled at 1937.9, and I moved my stop to 1938. This significantly limited the risk on the trade to break even. And I say here, I don't want to dance with the Fed at 2 o'clock. So if we do get a pop in gold, we can take advantage of that, but I don't want to sit and wait for the entire level to get blown out. And when we're consolidating like this before the level, once we make a new high, it's a pretty good bet that if we do come back and test it, we're going to move back through. So that's why I moved my stop a little bit early. So then I say that I took one off on gold on the back end of the Fed decision. So the notice of the interest rate increase came out at 2 o'clock. And then the Fed came out at 2:30 and was talking. And when we, I think this was around 2:16, something like that, we started to bounce off of Monday's lows. Monday night, Tuesday morning low. And I chose to take profit on one of the contracts that we had, locking in, about, what is that, the $3,000 some odd dollars. And I did that to protect our position and not let everything slip away from us. It's just not being greedy and understanding what can happen with volatility. I've been trading for a very long time. I know what can happen with prices when the Fed speaks versus the initial reaction. So it is prudent to take profits when profits come your way. And then we continued to move up in price, but with this leg up, it was actually very difficult to decide where to put my stop. So I used something called an average true range. And that's basically the likelihood of price moving one way without it turning around. That's a very simple version. But it was at 15 points. So I trailed my stop around 15 points from where the high was. And you can see at one point we were up $7,200 on the total of the contracts. We had one going at 41.50. And I said, okay, if we pull back about 15 points, I just want to take my profits. I don't want to play with the Fed anymore, even though I believe gold is likely to go higher in the long term. In the near term, I don't want to dance with the Fed. I want to be I want to limit my risk as much as possible and capitalize on my profits. So that's what happened. Price came back down. We got volatility that came in. All of the markets were up. Well, the NASDAQ was up over 1%. It is now down. Gold is falling with it. And we got out of the trade at 55.90. So while we got into the level properly, we noticed what was happening with our basing. We didn't get that as well. We were very aggressive because of A, the basing, because of B, it's Fed day, and we trailed our stops in a very prudent way that led us to $5,590 on the day. So this is really the way that I trade on Fed days. Number one is I don't take small levels at all. I have to use high time frame levels. And B, if the market moves very quickly in my direction, I need to take money where money is due, trail my stops, protect myself from getting whipsawed, turning a winner into a loser. So guys, hopefully you enjoyed this short little video on how to trade Fed day and happen to be gold. You can also do this on any of the other equity markets as well, or anything that's severely affected by the Federal Reserve's interest rate decisions. All right, guys, have a great day. And as always, guys, if you enjoyed this video and you want to find out more videos like this on how we trade, how we do what we do, give us a subscribe, give us a like, hit the little bell. That way you get alerted whenever we come out with new videos. Thanks, and I'll see you on the next video.